Arkansas Statutes, rules, and regulations common to life and health insurance. Up to this point, the concepts that you have covered have been ones that apply to the insurance industry as a whole. Now that you have examined insurance policies and their provisions, you can turn your attention to regulations and definitions that apply only to this state. You'll learn about a variety of topics, from the duties of the insurance department to licensing laws. This chapter is full of definitions and numbers for time limits and dollar amounts. Make sure that you know them for your exam. Terms to know. Cease and desist. To stop or discontinue coercion. Forceful act or threat aimed to influence a person to act against his or her will. Commission. Payment to the agent by the insurance company for placing insurance, usually a percentage of the policy premium. Commissioner. The head of the State Department of Insurance. Exempt. Not subject to an obligation. Home office, insurer's headquarters, principal place of business. Inducement, an offer that attempts to influence the other party. Solvency, ability to meet financial obligations, e.g., an insurance company maintains enough assets to pay claims. Statute, a formal written law enacted by legislature. Insurance statutes can be found in the State Insurance Code. A. Insurance and insurers. General definitions. 1. Insurance transaction. The term insurance transaction includes any of the following: by mail or any other means, solicitation, negotiations, sale, effectuation of a contract of insurance, and advising an individual concerning coverage or claims. 2. Domestic, foreign, and alien companies. Insurance companies are classified according to the location of incorporation, domicile. Regardless of where an insurance company is incorporated, it must obtain a certificate of authority before transacting insurance within the state. Know this: a domicile refers to the location where an insurer is incorporated, not necessarily where the insurer conducts business. A domestic insurer is an insurance company that is incorporated in this state. In most cases, the company's home office is in the state in which it was formed, the company's domicile. For instance, a company chartered in Pennsylvania would be considered a Pennsylvania domestic company. A foreign insurer is an insurance company that is incorporated in another state, the District of Columbia, or a territorial possession. Currently, the United States has 5 major U.S. territories: American Samoa, Guam, the Northern Mariana Islands, Puerto Rico, and the U.S. Virgin Islands. For example, a company chartered in California would be a foreign insurer within the state of New York. A company chartered in Puerto Rico will be foreign in any U.S. state. An alien insurer is an insurance company that is incorporated outside the United States. 3. Stock and mutual companies. The following are the most common types of ownership. Stock companies are owned by the stockholders who provide the capital necessary to establish and operate the insurance company and who share in any profits or losses. Officers are elected by the stockholders and manage stock insurance companies. Traditionally, stock companies issue non-participating policies, in which policy owners do not share in profits or losses. A non-participating stock policy does not pay dividends to policy owners. However, taxable dividends are paid to stockholders. The dividends are not guaranteed as they are based on company profit. Mutual companies are owned by the policy owners and issue participating policies. With participating policies, policy owners are entitled to dividends, which, in the case of mutual companies, are a return of excess premiums and are, therefore, non-taxable. Dividends are generated when the premiums and the earnings combined exceed the actual costs of providing coverage, creating a surplus. Dividends are not guaranteed. 4. Fraternals. A fraternal benefit society is an organization formed to provide insurance benefits for members of an affiliated lodge, religious organization, or fraternal organization with a representative form of government. Fraternals sell only to their members and are considered charitable institutions, and not insurers. They are not subject to all of the regulations that apply to the insurers that offer coverage to the public at large. In most states, fraternal benefit societies are permitted to issue life insurance, including endowments, health insurance, including medical and disability, and annuities. They do not issue property or liability policies. 5. Authorized and unauthorized companies and certificate of authority. Before insurers may transact business in a specific state, they must apply for and be granted a license or certificate of authority from the State Department of Insurance and meet any financial, capital and surplus requirements set by the state. Insurers who meet the state's financial requirements and are approved to transact business in the state are considered authorized or admitted into the state as a legal insurer. Those insurers who have not been approved to do business in the state are considered unauthorized or non-admitted. Most states have laws that prohibit unauthorized insurers from conducting business in the state, except through licensed excess and surplus lines brokers. Know this: insurers must obtain a certificate of authority prior to transacting business in this state. To conduct business in Arkansas, an insurer must receive a certificate of authority from the Department of Insurance. A certificate of authority indicates that the insurer has met the standards established by the department and is qualified to make insurance transactions in Arkansas. Unless waived by the commissioner, a foreign insurer must provide the commissioner with evidence that it has been actively engaged in the insurance industry in its incorporated state for at least 3 years prior to the date of the application to do business in this state. This requirement does not apply to subsidiaries of insurers authorized to business in Arkansas, or mergers or consolidations with insurers authorized to do business in this state for at least 3 years prior to application. A certificate of authority cannot be issued to an insurer which is owned or controlled by any domestic or foreign government, political subdivision, instrumentality, or agency. B. Insurance Commissioner. The Insurance Commissioner is appointed by the Governor, with the advice and consent of the Senate. The Commissioner must be a citizen of Arkansas and at least 30 years of age. At the time of taking office, the Commissioner must execute a bond to the state of Arkansas in the sum of $50,000 for the faithful performance of the Commissioner's duties. 1. General duties and powers. The Commissioner will enforce the provisions of the Insurance Code and execute the duties expressly conferred upon him or her by or reasonably implied from the provisions of the Arkansas Insurance Code. The Commissioner is authorized to enter into cooperative agreements with other governmental agencies inside and outside the state to regulate the business of insurance, including, but not limited to the following: licensing of insurance companies, licensing of insurance producers, regulation of premium rates and policy forms, regulation of insurer insolvency and insurance receiverships, and other matters relating to the effective regulation of the business of insurance. Examination of books and records. The Commissioner regulates insurance companies authorized to do business in this state. The purpose of the examination of insurers' books and records is to ensure that the companies remain solvent and conduct business in compliance with state laws and regulations pertaining to licensing, policy forms, rates, claims, and market conduct. The Commissioner conducts examinations of insurance matters as authorized by the Insurance Code. Every domestic insurer may be examined when they apply for their initial certificate of authority or whenever the Commissioner deems appropriate. Examinations must be conducted at least once every 5 years. In addition to the examinations expressly authorized, the Commissioner may further examine any person to determine whether or not they have violated any provision of the Arkansas Insurance Code. Each person examined must pay to the State Insurance Department the actual travel expenses, reasonable living expense allowance, and compensation for examiners and other persons assisting in the examination. 2. Hearings and notice of hearings and orders. Because the Commissioner's role is to enforce insurance laws and to protect the public from unfair trade practices. If the Commissioner suspects that an insurer or its agent has committed a violation or is engaged in an unfair trade practice, the Commissioner may issue a statement of charges and hold a hearing for any purpose deemed necessary, within the scope of the Insurance Code. Every order of the Commissioner must state its effective date, as well as its intent or purpose, the grounds on which the order is based, and the provisions of the Insurance Code pursuant to which action is taken. An aggrieved person may also demand a hearing, in which case, the Commissioner must schedule a hearing to be held within 30 days of receiving the request, unless the parties agree to postpone it. Once a hearing is scheduled, the Commissioner must give 10 days' notice to all parties affected by the hearing. The notice must provide the time and place of the hearing, as well as the content of the hearing. After the Commissioner makes a ruling, parties involved have 30 days to appeal the decision. Any request for additional arguments or a rehearing must be made in writing to the Commissioner, who may choose to reopen the matter. Within 30 days of the end of the hearing, the Commissioner must give a copy of the order on the hearing to the parties involved. The order must state the facts and the matters resolved by the hearing. Any party to the hearing may appeal the Commissioner's order within 30 days of receiving the order. In general, these procedural requirements also apply to hearings involving allegations of unfair trade practices. If the allegations are proven at a hearing, the Commissioner may order the person or insurer to cease and desist from committing the unfair or deceptive trade practice. 3. Penalties. Any violation of the insurance code may result in a suspension or revocation of a license or certificate of authority. If a licensee is convicted of a crime as a result of violating the insurance code, the Commissioner may impose a fine of up to $1,000 per violation, not to exceed an aggregate penalty of $10,000. If a person commits a violation willfully and knowingly, the penalty is $5,000 for each act or violation, not to exceed a total of $50,000 in a 6-month period. A person who violates a cease and desist order of the Commissioner will be subject to a monetary penalty of up to $10,000 for each violation, or suspension or revocation of license. Thanks for watching.